What's up, world? This is Sophisticated Investing Life, and today we're going to discuss how to analyze IPO stocks for potential investment. Now, this is a continuation on my How to Analyze Stocks series. So I started off with a video about how to analyze any stock, the basic framework to analyze any stock. If you have not checked out that video yet, it's linked up in the card above. Make sure to check that video out. Now, in the continuation of that video, I'm going to focus on specific things to look for companies that are going public, or they're going public now, or they've been public for the past couple of months, or even within the last year. So in addition to the basics I talk about in my other video, we're going to examine the company's path to profitability, like how they're going to become profitable if they're not. We're going to see how that balance, and we're going to see how that balances out with the company's growth plans, as well as digging deeper in the company's competitive advantages, as well as some details that are special to the stock itself that only happen for IPOs. So the first area we're going to dig a little bit deeper on is how the business makes money and how they're going to become profitable. Because most high profile IPOs like a Lyft or a Uber or a Zoom, they're unprofitable and they don't plan on being profitable anytime soon, right? Like real profitable, like cash flow positive profitable, like net income positive profitable. That's not happening anytime soon with these companies, right? Now, this isn't always a problem for younger companies. This is expected. You got to grow. You got to hit a certain inflection point, yada, yada. We get it. But it's usually not good to go public unless you're within a year or two of truly becoming profitable, right? And these companies have no idea when they're going to be coming out of the red. That is scary. That is definitely scary. And it creates a special risk called reflexivity. Now, what is reflexivity risk, right? Reflexivity risk occurs in companies that are not self-sufficient. So they don't generate enough cash to make their own investment. They don't generate any positive profitability. And they depend on getting cash from new or existing investors, primarily through the capital market. So either through debt or either through offering new shares to the public. Now, this is not a big deal in the beginning. No, it's not a big deal again. Every company has to start somewhere. You have VC investors that hop in. Every company has to start somewhere, right? But companies get into trouble primarily when they take their eye off the ball in terms of achieving profitability in their core business. So this is what creates the risk. So for example, one of the many things that went wrong with WeWork is that they took their eye off the ball by not only trying to grow super fast, becoming the largest tenants in both New York City and London, those expensive areas, but they were doing all these random acquisitions. Matter of fact, from 2015 to now, they had like 21 acquisitions, including buying a wave pool startup and a boot camp, like a coding boot camp. Like, why are you doing that? You're nowhere near profitability, damn it. I don't know what's going on, right? So watch out for companies that do that, right? It's part of the Silicon Valley culture of grow at all costs, and it was part of SoftBank just giving tons of money to these startups and trying to use that as a competitive advantage. But that's not the way to go. Make sure the company is focusing on becoming profitable in their core business, because if they're not, and they're always negatively profitable, then they can't make the next reinvestment or have to keep depending on going back to the capital markets. It's just too much downward pressure on the stock. Now, next issue at hand is competitive advantage, right? Does the company have a real competitive advantage, or as Warren Buffett would say, a moat? They actually have a moat. Now, this moat usually comes from either high barriers of entry, not a lot of competition, or it's tough for new competitors to spring up for various reasons, or high switching costs. It's hard to jump from one competitor to another, right? So examples of companies with high barriers of entry, for example, is Facebook. You can't recreate what Facebook did, right? It's hard to create that networking effect and hard to break in and be that effective. Others have tried, like Snapchat and Twitter, and you see how they're floundering, right? So high barrier of entry with the social network, or the video is the same Same way with their general processing units. Next level that AMD just can't catch up to. And examples of industries with high switching costs is, for example, mobile and internet providers like AT&T or Verizon. I mean, you're not changing your cell phone service year after year or your internet provider. You're usually locked in, and you're locked in for a while, right? Because there's just things that come with switching costs. And don't get me started on Apple. Apple gets on my last nerves when it comes to this. Because if you want to leave Apple and go to like Samsung, you know how much headache it takes to do that. Apples are they're genius for doing it, but it's messed up. But that's an example of very high switching costs, right? So a lot of these companies don't have that. They don't have either or. So for example, you can jump from Uber to Lyft relatively easily. You can do that jump depending on if you're trying to who has the better rate, right? For a ride, you can easily check on your phone. So that's scary. That is scary, and that's why some of the best investors, most well-known investors like Warren Buffett, usually don't mess around with IPOs because these companies don't have the moat that he likes to see. Now, speaking of Warren Buffett, have you ever wondered how he became the wealthiest investor of all time? Like, it's not even close. Even hedge fund managers have nothing on him, right? It's based off of 3 secrets. He has 3 secrets that the media does not cover. They do not tell you because they don't even recognize them themselves, right? So I'm here to share with you those 3 secrets. It's in a free PDF below in the description. Download my free PDF on his 3 secrets and how you can take those 3 secrets and even fast track your wealth building process to even 6 or even a 7-figure account in no time. Now, the last part to pay extra attention to when analyzing IPOs is understanding the dynamics around the stock itself. Now, some companies offer dual class shares or different shares for different voting rights, right? So Facebook is a famous one about that, with Mark Zuckerberg having his shares matter more than any typical shareholder. And WeWork was like, this is another thing that brought them down. Like horrible, absolutely horrible, where the founder, Adam Newman, he was going to have a special share class where one share was worth the vote of 10 normal common shares, right? So he just needed one of his special shares and it counts for 10 votes. So whatever needs to be done by him, he can get done. That's not good. That's that crap that's happening in venture capital, today. That's what's happening with the VC. So watch out for that. Some of these founders need to relinquish some control of their companies, right? That's not the best thing for shareholders. You must also understand who's already in the stock, right? You need to understand who's already in the stock on the private side. So this matters because who's going to be the incremental buyer once the company goes public and actually bid up the stock, right? So what you want to see are the good guys. You want to see the good guys coming in. Those good guys are long-term investors, right? It's the T. Rowe Prices and the Wellingtons of the world, right? They plan on holding the stock. They're true stock pickers. That's who you want to see coming in. This thing that's happening in the industry today is late stage private rounds, so pre-IPO investing. So instead of a Wellington or T. Rowe Price, instead of waiting till the company goes public to buy shares, now they're investing in that private round just before a company go public. So because of that dynamic happening, there's less demand from the incremental buyer once the stock goes public. So you need to watch out for that dynamic. And also, the bad guys, you gotta also watch out for those. So if it's a hot IPO, watch out for hedge funds. Watch out for hedge funds because the hedge funds are looking to get in, flip the stock after the first day pop, and get out. Which, of course, that's fine for the first day, but it puts downward pressure on the stock. So that's why most stocks go down after they initially go public. And it's even worse, it's absolutely worse for companies coming off of their lockup period, right? So 6 months after a company goes public, what usually happens is all those private investors, those venture capital investors, they're allowed to actually exit the stock. And when they exit, they usually exit in mass, right? And the stock market usually knows, which is around, month 5.5, the stock naturally goes down, right? So if you're actually really interested in buying a company, wait until that 6-month period after the stock goes public. That's probably the best time to do it. So for example, Jeremy from the Financial Education Channel, he just bought Uber stock, which is about 6-7 months, right? So it's already off of its IPO lockup period, right? The private investors are already starting to leave. So it's put downward pressure on the stock. It's at new lows. So it's definitely an interesting way to think about things. And to learn more about Jeremy's take on Uber as a stock versus a hedge fund manager's take, make sure to check out that video in the card above. Well, there you have it. How to analyze IPO stocks. What makes these stocks different than the average company and the special quirks that come with them. If you like this type of content, make sure to tap that like button so we can spread the message on how to truly become top investors in the world, right? And actually separate yourself from the average investor. And don't forget to download my free PDF on Warren Buffett's top 3 investment secrets, how you can use those to fast track your wealth building journey. So that's all I have for today. So thank you for watching and stay sophisticated.